muted.
Welcome to our second quarterly call for 2016. We have muted all of the phone lines, and Peter O'Keefe and Justin Stevens have the microphone. This call is being recorded and will be available for replay by visiting www.sageready.com and clicking on any of the O'Keefe and Stevens team members' profiles, then selecting the resource page. Before we get started, we must remind you that the purpose of today's call is educational and that the material presented is publicly available information from sources believed to be reliable. The information in this material may change at any time and without notice. Furthermore, this presentation is not intended to provide specific advice to any individual's personal circumstances. You should consult with your accountant, attorney, or financial advisor based on your own individual situation. This call will be available for replay on the O'Keefe and Stevens resource page, which can be found at the Sage Ready website. Please contact us if you would like a link to the recording of the call or any previous calls.
Thanks, Carly. And thanks for joining us on the call today. I want to start our talk today by spending a little time explaining an important concept that is fundamental to our investment process: intrinsic value. Justin and I will spend time explaining what intrinsic value is, how we use it, and we'll try to relate it to daily life so you can have a better understanding of this important element of our investment process. Next, we'll review three investments that we own: Trinity Place Holdings, NVIDIA, and Berkshire Hathaway. Two things to pay attention here are, number one, the diversity of these companies and the risks that they carry. So often, investors make the mistake of owning lots of companies as diversification. And it's not so simple. True diversification means owning assets that are distinctly different with different risk. It is not necessary to own a large number of companies so long as you understand the risk associated with each individual asset and how it is distinctly different from each of the other assets that you own. Second, pay attention to how intrinsic value is determined in different ways for each company. What would be nice is to have an exact formula to reliably know what the intrinsic value is, but it's actually a blend of art and science that determines this value. And finally, we'll turn off the recording and open up the lines at the end of the call to answer your questions. We didn't receive any questions prior to the call, but you can type questions into the message box during our talk, and we'll answer these questions first, and then we'll move to an open question and answer format.
Well, thanks, Peter. So moving into intrinsic value, I actually want to start by reading a quote from the book Security Analysis, which is a foundational book for value investors, written by Benjamin Graham and David Dodd in 1934. And quote goes like this: "Intrinsic value is an elusive concept. In general terms, it is understood to be that value which is justified by the facts. For instance, the assets, earnings, dividends, definite prospects, as distinct, let's say, from the market quotations established by artificial manipulation or distorted by psychological excesses. But it is a great mistake to imagine that intrinsic value is as definite and as determinable as is the market price." And that quote comes from page 64 of this 700-some page book, Security Analysis. In simple terms, what they're saying is intrinsic values are a determination for what the business or security you're buying is actually worth, based on the current facts, and not so much based on the assumptions of the future, although you do need to think about that. And our point is it's entirely possible for two different analysts to come up with completely different values for the exact same company. This is in part because some analysts place a greater emphasis on aspects of the business that others may not. Earnings are a great example of this. Some analysts rely heavily on projections of the future earnings of a business, where others might feel uncomfortable with these estimations and prefer to rely on earnings of the past and look to how the company has allocated those earnings during different economic situations. We feel this is a far more conservative approach that would likely produce a lower intrinsic valuation. That whole idea here is that there's a range of values that exist for any security we buy. Our aim as analysts is to identify a conservative value for all the businesses we own. We want to know what we're buying, and we want to know what it's worth. So we talk about being intimately familiar with the securities we own. This intrinsic value is what we're referring to. So I want to give it to Peter, who has an interesting story on intrinsic value.
Thanks, Justin. I kind of approach it this way. Have you ever been to a garage sale and found something that you know to be worth $100, but you can buy it for $50, but you know it's worth $100? Well, that's what we're looking for when we buy our investments. We're looking for temporary dislocations of price and value. We know that if we hang on to something that we bought at a good price, eventually it will be realized and someone will be willing to pay hopefully full value at some point in the future. Let's take that garage sale example a little bit further. Imagine we went again to another garage sale and found the exact same item now selling for $30. Would we buy more of it? Absolutely. Being able to buy things at a discount does not mean that you're always able to buy them at the absolute lowest price. But when you know that something is worth, you're confident in buying it at any price below intrinsic value. If you have a good idea what something is worth, we know that if we're buying or selling it at a premium or a discounted price. So we're looking for good values, which means paying discounts for a business compared to what we believe it to be worth. When a significant discount no longer exists, we stop buying or may even sell the security. In some instances, we're willing to wait and sell the companies until they're being sold at premium prices. We're going to be talking about buying and selling and holding 3 examples today. Our first investment is Trinity Place Holdings. We began purchasing Trinity Place in March of 2014. The company is the remnants of the Sims Corporation and is primarily made up of real estate holdings of the company. We felt that coming out of bankruptcy that we could buy the company for less than the true value of the real estate, and they had also placed a highly capable management team to direct the redevelopment of those assets. Eventually, we feel the underlying value of this real estate will be recognized and will be rewarded for having bought those assets at discounted prices. In 2015, the company had a rights offering, which many of you may have participated in, to raise money to begin the development of their prized asset at 77 Greenwich, which is in the Battery Park area of Manhattan. The slide has the architect's renditions of the future developments at this property, which is slated to be completed in 2019. The property will have outstanding views of the Hudson Harbor and the Statue of Liberty and will be comprised of retail, the condominiums, and a school which will be operated by the City of New York. Additionally, Trinity Place has significant intellectual property in several brands such as the Filene's Basement. This is an excellent example of a stock that we would prefer to hold until the intrinsic value is realized by the market. Next, we want to give you an update for NVIDIA Corporation. NVIDIA, we began purchasing in March of 2013 after a significant drop in the price of the stock from $40 to under $10 per share. At the time, NVIDIA was the dominant company for game processing units, or GPUs. These are advanced computer processors that are used primarily in the gaming capacity. The company had over 60% market share, and its main competitors were Intel and Advanced Micro Devices. Intel licenses several of NVIDIA's technologies, and AMD's financial health was declining, and they were losing market share to NVIDIA. Fast forward to today, NVIDIA now has almost an 80% market share in the GPU space. This is exactly the type of growth we'd love to see in a company that we own. Now, since we owned it, there have been additional markets including deep learning, autonomous automobiles, virtual reality, and data centers that NVIDIA now provides valuable products to. There are many more opportunities across greater industries, including medical and automobiles, which will allow NVIDIA to experience continued growth. During this time, the stock price has risen significantly and most recently has done an outstanding job due to growth in their profits. In 2015, the company deployed more than $800 million in cash dividends and share buybacks, and in 2016 they announced another $1 billion using the same two levers to produce shareholder value. Going back to intrinsic value, when a company experiences this type of rapid growth in share price and expansion into new industries, we need to go back to our valuation and potentially reconsider what the company is truly worth. We're in the process of doing this right now. We may decide that it's either sensible to pare back our positions in NVIDIA, as this company now represents a significantly higher percentage to many investors' net worth and carries a different risk profile than it did when we initially purchased it. The growth could very well continue, and we may decide with the investment, but as responsible stewards of your wealth, we need to constantly be considering what the risks are that we're taking on any type of investment that we own. Justin?
Thanks, Peter. So I had the opportunity to visit Omaha, Nebraska at the end of April for the Berkshire Hathaway annual shareholders meeting. This was an experience of a lifetime for me. The actual meeting, the people I met, and the amount that I learned from the trip are unmatched so far by any other experience I've had in business. The slide has a picture of me in front of Warren Buffett's house with some other advisors that I met on my trip from around the country and a couple members from the White's Management investment team who I also got the chance to visit with in Omaha. So the shareholders meeting was formatted unlike any other shareholders meeting I've ever been to. The first part of the meeting, they started with a very comical 45-minute parody video that highlighted all the different brands and companies that Warren Buffett owns in Berkshire Hathaway's portfolio. The next 30 minutes were your normal course of business, where they give a brief overview of the business items for the shareholders meeting and also introduce the very impressive board of directors, which includes people like Bill Gates. And then it took a turn. The next 7 hours of the meeting were dedicated to open question and answer, where audience members, the media, and then people who could submit questions online could ask Warren Buffett and Charlie Munger to comment on anything from investments to their personal views on the future and their life experience. I actually have my notes on the meeting up in this presentation in the handouts section. You can download those. I'm also happy to share those notes with anybody who sends me an email. Way too much notes to go through in this call, but truly an outstanding experience. The genius of these two men is in their simple and humble approach to life, and in listening to them talk, you become aware of exactly why they've been so successful and have created such an outstanding following. There were over 40,000 shareholders at the meeting that weekend in Omaha. It was quite the event. So the next slide shows some of the businesses that Berkshire Hathaway owns. As a company, Berkshire Hathaway is an incredibly diverse portfolio of outstandingly managed companies. This slide is a picture of many of those brands, but certainly not all of those brands. I'm sure you've seen a lot of these companies and may not have even realized they were owned by Warren Buffett. We think of Berkshire Hathaway as a massive mutual fund that is being managed by arguably the most successful capital allocator in recorded history. These businesses benefit in many ways by being a part of Berkshire Hathaway. Take, for instance, the most recent purchase in Precision Castparts, which was a stock that we owned for a period of time. Warren Buffett commented on the management at Precision Castparts and how they no longer need to spend time reporting to analysts, the media, filing reports as a publicly traded company. Instead, this highly talented group of managers can shift their focus on the priorities of growing that business and building the value of the company. And furthermore, they have some of the deepest pockets in the world to go to if they're looking to expand and need financing. This provides an extraordinary competitive advantage, and we feel it's not truly represented in the per-share price of Berkshire Hathaway. Each of the companies that Berkshire owns benefits from this relationship in different ways. A good example is Berkshire Hathaway Energy, which is the low-cost producer of wind energy. They're able to achieve significantly lower costs of production because their parent company has significant earnings from other profitable businesses. This allows them to fully utilize the tax credits provided by the government for sustainable energy operations. None of the other competitors have that ability. At this time, Berkshire Hathaway, it's trading at about 1.3 times its book value, or in simple terms, the sum of all its parts. We feel that this book value, as measured by traditional methods, is severely undervalued. In reading Warren Buffett's his annual report to shareholders, he comments about the many instances in which the company doesn't mark up their assets to current market valuations and instead reports their initial basis as a contributor to the book value. We feel that this relationship between price and book value makes for an attractive opportunity to buy Berkshire Hathaway. We're supported in that thought by Warren Buffett himself, who in the meeting stated that if the relationship became 1.2 times book value, he would consider buying back shares of Berkshire Hathaway, as he feels this represents a significant discount to his calculation of the intrinsic value. So one question that came up multiple times during the meeting was, what happens to Berkshire Hathaway when Warren and Charlie are no longer leading the company? There is a succession plan in place, and while we can't comment on exactly what would happen to the share price of Berkshire if Warren Buffett were to resign as the chairman, we do know that this company is a fortress that will remain intact and continue to produce shareholder value for a long, long time into the future. So again, if you're interested in reviewing my notes from the meeting, please either send me an email or you can download from the handouts section. I'm happy to share my experiences, and hope to be talking with many of you about this company soon. So with that, we're going to wrap up the recorded portion of this call. We'll unmute the phone lines for our question and answer session. Thanks for tuning into the O'Keefe and Stevens team's second quarterly call for 2016. This concludes the June 1st, 2016 quarterly update call. This call is again going to be archived in our library and can be requested by emailing any member of our team.